We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. You can always go to the website to learn more, DeckerRetirementPlanning.com, DeckerRetirementPlanning.com. Find out more about Brian and the team, where the offices are, and all of that. The team's here. It's right there in the name, Decker Retirement Planning. They're here to help you plan for your retirement. Do you have enough? Are you going to be okay if you retire? Will your money last as long as you need it? All those things you wonder about when it comes to retirement. A lot of great information on that website, DeckerRetirementPlanning.com. Now, every time I start this show, and I'm Mark Elliott, glad you're with us, we give you the opportunity to go to that website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. There are 12 different things you could download just for your information, including Brian's book on retirement, the Decker Approach book, 3 Principles of Retirement book, the Checklist Challenge, and there's even a sample income plan. That's just 4 of the 12 things you can download. And it's really all there. Brian and the team have put it there for you to learn more. You got questions, go find something in there, and maybe it'll help clear some things up. And if not, you can always give them a call. There's no cost to chat with them. 833-707-3030. 833-707-3030. We'll give you that number throughout the program. Brian, today, it is not Brad Geddes. It is not one of our normal guests that are on with you. It is a brand new person you're going to introduce to our audience today. Who do you got coming in today?
We have Mark Knauss up, and he is our Bellevue planner. He's a CFP. And Mark, why don't you tell the audience about yourself and your background?
Yeah, happy to. So my name is Mark Knauss. I was born and raised here in the Edmonds area and went to Edmonds Woodway after high school. I joined the Navy and did the Navy for 10 years. I was a cryptologist during that time. And while I was in the Navy, I got really excited about personal finance and saving and investing. So after 10 years, I left the Navy and got my degree from University of Washington in finance. And I have since gotten my certified financial planning designation. The CFP designation is kind of the industry standard when it comes to retirement planning, and it's like a master's degree in retirement planning. So I've been doing this for going on 13 years now. I absolutely love working with clients and putting together financial plans for them and working with them on their finances, on their portfolio, on different tax strategies and income strategies. It's such a blessing to be able to do this. And in my spare time, I like to hang out with my wife and my kids. I live up in Woodinville, so I just love the Washington area, and the people around here are so wonderful to work with.
Mark, what, not that I don't really know, but thanks for your service. What is a cryptologist? What did you do as a cryptologist?
So a cryptologist works with information technology and Navy intel to basically intercept, decode, and relay information onto the warfighters so that they can make tactical and strategic decisions. So a lot of what we did was intercepting communications.
There you go. All right, Brian, you got to be careful when you're sending inter-office memos. He's going to be there breaking it down. He's going to read between the lines. Better make sure you're on top of it.
We need a cryptologist to get through this radio show, to interpret what I say. All right. Well, let's dive in. Mark, it's sure a joy to help people in the Seattle area, to help them in the retirement planning. They come to us. They, for probably 35, 40 years, have operated under different rules of accumulation. So tell our radio audience how the rules of accumulation work and how the rules of distribution work, because they're quite different.
Quite different. So what I've found over my time doing financial planning is that so many advisors, bankers, and brokers out there are so focused on the accumulation of assets. And you go and you talk to a financial advisor, banker, broker, and they'll usually take you through something like a risk tolerance questionnaire. And based on your time horizon and risk profile, they'll put you into some kind of a stock bond asset allocation pie chart that's got, large cap stocks, medium cap stock, small cap, tech sector, and then some bonds. And they'll tell you, there you go, that's your retirement plan. There you go. You're all set. And if the stock market crashes, well, then you'll just go along with it, but hold on because over time the markets will recover. And I say that that is a great strategy when you are in your accumulation years, when every 2 weeks you're getting an income from your employer and you're making a 401k contribution or 403b contribution, and say the market is down, you're in a market correction time period, and you're putting new dollars into that pie chart, then all of a sudden, as the market recovers, the 3 to 5 years that it takes for the market to recover, you actually end up in a much better spot because you were buying stocks on sale. And in that recovery, now you've got more stocks that you bought for less dollars and you're off to the races. That's the accumulation period when you're putting new dollars into your portfolio. But then change the script. Now you're 60 years old, 65 years old, and your portfolio is your paycheck. You can't take the same kind of risk in your portfolio because you need that portfolio to be your stream of income in retirement. So it's a completely different discussion. It's a completely different strategy that you need to implement in the distribution phase of life than you used in the accumulation phase of life.
Okay, I'm going to say what you said a little different. In your 20s, 30s, 40s, 50s, you buy and hold, you've got your 401k, market goes down 30, 40, 50%, no big deal. Every 2 weeks, you're kicking in new money into the portfolio, your 401k, your income is coming from work. So you ride it out. You have the time, the 3 to 5 years for the markets to recover, and no big deal. You just ride it out. You accumulate, you grow that money. But once you hit 60 plus, you've got to use different strategies. Mark, we use in the seminars kind of an illustration about heading up and down the mountains. Much more people, 10x people die going down Everest than they do going up. They take all kinds of time and planning to get up the mountain. But once they get up the mountain, they really have not spent a lot of time getting down the mountain. A lot of people in accumulation years have a plan to get to retirement, but once they're there, they make the mistake thinking that the strategies and the rules are the same, and they're not at all. So in your 20s, 30s, 40s, markets drop 30, 40, 50%, no big deal. You actually benefit because you're kicking in money every 2 weeks into your 401k into a down market, and you've got the time to recover. Now, once you're 60 plus, and you're drawing from that portfolio for your income, this is very important, from that portfolio that is now down 30, 40, 50%, that is a game changer. You can't do that. If you do that, that is lethal and you'll have to go back to work. So we want to outline distribution strategies. We are specifically experts in distribution strategies. Mark, how is distribution different? Like, for example, we talk about 3 strikes. So what are the 3 strikes or the headwinds that people have going into retirement that they have to deal with that's different in distribution planning?
Well, part of it is what you had just mentioned, the asset allocation pie chart is probably the first real risk when it comes to retirement planning. Putting your money into a pie chart that is correlated to the stock market, I would say something in the neighborhood of about 90% of Americans will use that as their retirement plan. And it's because bankers and brokers and financial advisors are trained on this. Whenever somebody becomes a financial advisor, this is how they're trained to manage a portfolio. But that is a strategy that works on the upside, but it does not work on the downside. And as you get close to retirement, that can really hurt you. So, strike number one, if your advisor is telling you that a pie chart is a financial plan and a retirement plan, it's not. Number two is you look at that pie chart and you break
I want
it
to go
down.
back. Mark, I want to go back to number one.
Yeah.
The number one fear of people in retirement is running out of money before they die. And I feel sad for the American public because they are told by bankers and brokers to look at a pie chart and calculate how much money you can draw for the rest of your life. And nobody can do that. Nobody can do that. So they underdraw from their portfolio. They could be drawing much more, but they underdraw, and they're constantly worried about running out of money before they die because a pie chart is not a retirement plan. So you're right. That's point one, strike one against bankers and brokers as retirement planners. What is strike two?
Well, and in addition to what you were saying, they're always concerned about the next market crash because they've seen so many people in their lives that their retirement plans have been blown up because of a market crash environment. Strike number two is when you're looking at this pie chart specifically, there's something called the rule of 100. The rule of 100 says as you get older, you should have more and more bonds in your portfolio, as if bonds were some magical thing in a portfolio. So what you do is you take your age, you divide it by 100. So say you're 65 years old. 65 divided by 100, you should have 65% of your portfolio in bonds, which advisors will tell you that that's your safe money, that bonds are a good investment and bonds are your safe money. Well, the reality is that if you look at the 100-year history of the 10-year treasury yield, you'll see going all the way back to the 1800s, 1900s, that for 50 years, bond markets and interest rates were pretty flat. But then starting in the 1940s, going all the way to 1980, we saw interest rates go from about 2% up to almost 15%. And bond funds have what's called a negative correlation to interest rates. So when interest rates go up, the value of bond funds go down. So then from 1980 to 2020, we saw interest rates come down. We saw them come down from almost 15% down to 0.47 in August of 2020, all-time lows. When interest rates are at all-time low, interest rate risk is at all-time high because you can't go any lower in interest rates. That means that is the highest that bond funds are going to be worth. And since August of 2020, we've seen interest rates spike from 0.47 up to about 4% is where they're at today. And bond funds have gone through the worst rout in U.S. history during that same time period.
So again, if you have questions about any of this and you're thinking, wait a minute, if I'm 65 years old and I've got 65% of my money at risk, it's supposed to be the other way around. Well, everybody's situation is unique. That is one of the keys to the team at Decker Retirement Planning, Mark and Brian and Brad and the team. It's all about whomever they're sitting down with. How can they help you be in a better position and understand? Brian always says all the time that most retirees are so afraid of running out of money before they run out of life. They're not enjoying their retirement the way they could if they actually had a plan. Well, if you had the safer retirement plan that Brian and the team at Decker Retirement can do for you, income, investment, taxes, healthcare, legacy planning. What about Social Security? It's in the income part. What about Medicare? It's in the healthcare part. A lot of pieces are moving on the plate that weren't when you were working. It's a different world. This is a great opportunity to have the team at Decker Retirement kind of walk you through your situation. Whether you become a client or not is really not the point, I think. I think it's about you getting clarity into your picture, retirement picture, and that's what certainly Brian and Mark and the team at Decker Retirement can do for you. All you have to do is give them a call. You got questions, You got concerns, 833-707-3030, 833-707-3030. Might be the most important phone call you make. Back with more of Safer Retirement Radio with Brian J. Decker and Mark Knauss of Decker Retirement Planning. Back right after this.
You have enough things to worry about. Market volatility shouldn't be one of them. Make sure your retirement plan doesn't rely on the ups and downs of the market. Call the Decker Retirement Planning Team to get started at 833-707-3030. That's 833-707-3030.
Do you want your retirement to be affected by who was in the White House? I didn't think so, but here's the thing. No matter who wins this time, they'll only be in the Oval Office for 4 years. But how long will your retirement last? Presidents can have a huge impact on taxes and the economy, but there is another presidential election in 4 years, then another, and of course another. Brian Decker at Decker Retirement Planning can help you create a customized plan that's really as White House proof as possible. Schedule your visit with Brian Decker today by calling 833-707-3030. Brian doesn't know who will win in November, but he can help you prepare for it, no matter what happens. Reach out to Brian Decker to get started. Call 833-707-3030. Don't let who's in the White House affect your retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Mark Knauss of Decker Retirement Planning. Again, DeckerRetirementPlanning.com to learn more. Questions, concerns, 833-707-3030 is the number. No cost to chat with the team. Totally complimentary. They're here to help you if they can. 833-707-3030. I'm Mark Ellie. Glad you're with us today. All right, Brian, Mark was into that second strike. So maybe kind of reset where we are right now.
Okay, so what I wanted to say about the second strike is that when interest rates are so low, bankers and brokers were still telling people to put their safe money in bond funds. When interest rates go up, bond funds lose money. When interest rates are at 0.47 in August of 2020, there was hardly anywhere to go except for up. We say that it's malpractice to be recommending bond funds, and we've been consistent on this. We have radio podcasts that go back 6 years. We were warning people of interest rate risk. So from 1940, when the 10-year Treasury was at 2%, to 1980, there were 40 years of rising interest rates, like Mark said, and then 40 years of declining interest rates from almost 15% in 1980 to 2020 at 0.47. In the last 4 years, Mark, people have lost about 35% in their quote unquote safe money. Now, with the instruments that we use that have no interest rate risk, how much money did our clients lose in the last 4 years due to interest rate risk?
Zero.
Zero is right. So on this interest rate risk point, this is fascinating what's going on. Ron mentioned that in the last almost 2 months since the Fed has lowered rates, the 10-year Treasury rate has gone higher, not lower. So if people are expecting that the Fed rate cuts are producing lower interest rates, they are not. So in retirement, you do not want to have bond funds in a rising interest rate cycle. This can go on for many, many more decades. And so we want to warn you, this is strike number 2. Strike 1 is any advisor that tells you to put your money in a pie chart and tells you that that's their retirement plan, that's strike 1. And any advisor that tells you to put your safe money in bond funds is strike 2, because we're in a rising interest rate environment. So Mark, I interrupted. So keep going on strike 3.
So when we're looking at strike 3, we look at what is the stock allocation of your portfolio. Right now, with valuations at extreme levels, we look at what's the history of the stock market. There's been 4 times in U.S. history where the S&P has traded at 32 times trailing earnings, going all the way back to the Great Depression era. We saw it in 1929, followed by a 17-year period of no market growth. We saw it in 1964, followed by an 18-year period of no market growth. We saw it again in 1999, where we saw the dot-com crash, the housing market crash, 14 years of no stock market growth. And then we saw it again recently, November 2021, we saw the S&P trading at 32 times trailing earnings. And if history repeats itself, which it has 100% of the time, going back to the 1930s, we could see a period of 10, 15, even 20 years of flat, choppy markets with no growth in a passive buy and hold strategy. If that's the case.
Define what passive means.
So a passive buy and hold strategy is one that just tracks the S&P 500. The idea is keep your costs low, be in a diversified strategy that just tries to track with the S&P 500, and over time you'll get S&P like results or some kind of a correlation to S&P like results. But if you are in that kind of a strategy, you could see no portfolio growth for 10 to 15, maybe even 20 years. And if that's what you're going into retirement expecting, say a 6 to 8% portfolio return, and you get 0 for 10, 15, 20 years, that's how retirement plans get blown up. That's why we don't do it that way. We don't recommend that, because we've seen retirement plans struggle when they're going into that type of a market environment.
So to be clear, on strike 3, any buy and hold recommendation in a flat market cycle should be strike 3. Buying and holding stocks, mutual funds, indexes, ETFs, buying and holding is not going to work in a flat market cycle. And in retirement, 10 to 15 years of flat markets is devastating.
Mm-hmm.
So that is strike 3. And Mark, if there was a strike 4, what would that be? Speaking of the 4% rule.
Yeah, absolutely. So we hear this all the time. A very common rule of thumb in retirement when it comes to distribution strategies is something called the 4% rule. This was developed back in the mid-90s by a financial advisor. And he looked at the history of the stock market and the history of the bond market. And he said, well, stocks usually get about 8% a year. Bonds usually get about 4% a year. So as long as we keep our distributions to 4%, then you should be good for the rest of your life, taking 4% from your portfolio every year without running out of money. Now, I would look at when that philosophy was developed. It was developed in the mid-90s when we were in the middle of a tremendous bull market cycle. That strategy does work really well when the market is going up, when the market is getting 8% a year and bonds are getting 4% a year. Where it doesn't work is in a flat, choppy market cycle like we saw in 2000, 2001, 2002, all the way to 2014. If you had retired when the market was at its peak in 2000, and you start drawing from your portfolio 4% a year during that time frame, well, the market is down 50%, your stock allocation is now down 50%, and you're drawing 4% on that portfolio. So you're not down 50%, you're down 62% because you were taking 4%, 4%, 4%. Then the market rallies 100% from 03 to 07, but you're taking 4 and 4 and 4 and 4. So now you're not up 100%, you're only up 80%. Then the market crashes again, down 50%, and you're taking 4 and 4. Then the market rallies again. Point to point, the stock market is flat from 2000 to 2014, but your portfolio is down 30%. And that becomes extremely difficult to recover from.
Now
So
we
the
have
4%
Mark,
rule.
Mark, we have proof that that really happened. Do you remember all the gray-haired people that showed up in 2009? They became, they came. You saw them in banks. We saw them in Walmart. We saw them. We saw them. They had to go back to work because the 4% rule destroyed their plan. Tell us about William Bengen, what he said in 2009.
Yeah, in 2009, during that housing crisis crash, William Bengen was the financial advisor that developed the 4% rule. And he came out in 2009 and he said, actually, it doesn't work. He disavowed his own hypothesis because he realized that in a flat market environment, the 4% rule is deadly. It's probably the most toxic piece of financial advice out there and has been responsible for destroying so many retirement plans. But by then, the cat was kind of out of the bag. It became a rule of thumb. And now all the financial advisors out there are just using this as kind of a lazy distribution strategy. So we don't use it. We don't like it. We use math to determine what your distribution strategy should be rather than a rule of thumb.
Okay, those are the headwinds for retirement. Totally different planning for retirement than what got you to retirement. Accumulation versus distribution. I know I use a silly analogy, but I had a knee replacement a couple years ago. I didn't go to a dentist. Dentists are nice people, honest, hardworking people, but I needed a specialist that would do what I needed done. We are specialists in retirement planning.
So again, if you would like to have a conversation with the team at Decker Retirement, all you have to do is give them a call. There is no cost to you. The reason I say it's one of the more important phone calls you'll make, because most people, maybe 20% of Americans, actually work with a retirement planning team. Most are still working like Mark and Brian were talking about, the pie chart retirement, working with their broker, because it's all about growth. We've kind of been learned that. Well, retirement's about growth, but it's also about safety. How do we make sure our money lasts as long as we need it to? And that's really what is important. And you can find out where you are just by having a conversation with the team. Get some clarity into your retirement picture. That's the old MasterCard commercial. That's priceless. 833-707-3030 is the number. Again, no cost for this chat. There's no pressure. There's no obligation. There's no judgment either. The team's here to help if they can. And if you like their help and it makes sense for you and it makes sense for them, there you go. 833-707-3030. We're going to come back. We're just halfway through. We got a lot more to get to. Brian, Jay, and Mark are back with more right here on Safer Retirement Radio.
In the world of taxes, knowledge is power. Let the team at Decker Retirement Planning empower you with the insights and strategies needed to navigate the complexities. Dial 833-707-3030 to stay ahead of the tax game.
Welcome back to Safer Retirement Radio with Brian J. Decker and Mark Knauss of Decker Retirement Planning. I'm Mark Elliott. Again, you can go to the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. There are 12 different things you can download and that are really there just for your information, your knowledge. You want to find out something about a different topic that pertains to the financial world or the retirement world. There you go. DeckerRetirementPlanning.com under the heading of Safer Retirement Education. And a great place to start would be with Brian's book, the Decker Approach Book, all about retirement and things that you would need to know and understand. Brian and the team are certainly here to help. You can always give them a call. It's 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us today. All right, Brian, you've covered a lot so far. Headwinds for retirees, the challenges we all face. Now you're going to talk about something that we hear about all the time, fiduciary. Where are you going with fiduciary?
A lot of people claim that they're fiduciaries. So rather than call them, I don't know, something rude, let's give some checks to see if you are in a spot where you can write this down, this is worth jotting down. There's 3 ways that you can tell if your advisor is a fiduciary or not. Mark, do you want to jump in and hit that list?
Yeah, so the first thing you always want to look for is, are they an independent firm? A non-independent firm is going to be something like Vanguard or Schwab or Fidelity. If you go to one of these firms to structure your portfolio, well, what kind of funds are they most likely to recommend? They're most likely going to recommend their own firm's funds. So if you go to Vanguard, you're going to get Vanguard funds. If you go to Schwab, you're going to get Schwab funds. If you go to Fidelity, you're going to get Fidelity funds. Are those the right funds for you? Maybe, but they are beholden to their company to put you in those funds, and they may or may not be the right fit for you or the right strategy for you. So the first thing you need to look for is, are they an independent firm? The second one is, are they a Series 65 licensed advisor, not a Series 7 advisor? So a number of differences between a Series 65 and a Series 7 advisor. I'll get into some of the more non-fiduciary products that are sold by Series 7 advisors out there that we don't like, we don't use, and we recommend clients stay away from. The first one that we see all the time being sold by Series 7 advisors is something called a variable annuity. A variable annuity is probably the most non-fiduciary product out there because there's so many layers of fees when it comes to these. Typically, the banker, the broker, the advisor gets paid a commission up front, so that's your first layer of fees. The insurance company that carries the product gets paid every year you own it, and the mutual fund companies inside the variable annuity also get paid every year you own it. So you can see that there's layer upon layer upon layer of fees. Typically, they add up to about 5 to 7% a year in fees before you make a dime.
And Mark, I just want to add, there's no disclosure on that. People don't know that they're paying all those fees.
So we don't like those. We don't use them. If you have them, feel free, jot a note, and I'm happy to take a look at them and give you some thoughts on those. But we stay away from variable annuities, lifetime annuities, life annuities, income riders. We don't use those. We don't recommend those because they are not in your best interest. For the vast majority of people, they are not a fiduciary recommendation. The second thing that we look for is something called a non-publicly traded REIT. You might have heard of this before. This is probably the highest commissionable product in the industry. This is where the advisor, or the banker, the broker, they typically will make about a 12% commission on these. It's paid upfront and it comes directly out of your principal. And the advisor doesn't show you the price on these for about 2 to 3 years because they don't want you to see the hit that you've taken on that account. So we don't recommend those either because of the fee load that you end up paying. The third one is something called a C-share mutual fund. This is where you go to your banker, your broker, and you tell them, hey, I don't want to pay any upfront fees on this mutual fund. Oh, and by the way, I don't want to pay any back-end fund loads either. So your advisor says, I've got just the thing for you. I know what I can do. I can put you into what's called a C-share mutual fund.
No, Mark, they don't even tell you. They say, okay, I've got just what you need. And they don't tell you that they've doubled their fees. People I know that have C-share mutual funds, they were never told that their fees went from 1 to 2%, that right. 12B1 fee. So no, they don't tell you. That's the whole thing. Being a fiduciary, you have to have disclosure. We could never do variable annuities. We would never be able to do the huge commissions, like you said, of non-traded REITs or C-share mutual funds. We'd be penalized for that because of non-disclosure. But Mark, there's another biggie.
The biggest scam in the industry, and we see this so many times. This is where your banker, your broker, your advisor tells you, hey, I can get you something that gets 7% guaranteed for 10 years, and then you can take 4% of that account value for the rest of your life. That sounds nice.
Wait, that sounds really good.
Yeah, but if you apply the math to that, let's just kind of walk through what that looks like. So say you're 65 years old, you put $100,000 into that strategy. So from 65 to 75, you wait 10 years, and you get that 7% a year, right? 7% a year for 10 years. Now you're 75 years old, and that $100,000 that you put in has doubled to $200,000. Fantastic. So now you can start taking 4% on $200,000 for the rest of your life. 4% times $200,000, that's $8,000. $8,000 from 75 years old for the rest of your life. Well, how long do you have to take $8,000 out of that policy every year before you get your own money back? You have to take it for 12 and a half years. So you waited 10 years for it to mature, and then you wait another 12 and a half years for you to get your own money back. Now you're 87 and a half years old before you get a dime of the insurance company's money back. One more strategy out there that we don't touch. We don't like those. Probably the most, inefficient growth strategy out there. We don't like those. And if you have those, let us take a look at it. We're happy to give you some thoughts. But that is a huge scam in the industry.
Okay, Mark. So the difference between what bankers and brokers can do and a fiduciary, it really boils down to a whole bunch of bad products with no disclosure. And you mentioned four great examples. But what if someone says, hey, I'm duly licensed?
Well, we've seen this in the industry too. Some advisors have both licenses. There's Series 65 and Series 7. The problem is that when that advisor is talking to their clients, you don't know whether that advisor is talking to you wearing their Series 65 hat or their Series 7 hat. So you don't know if you're getting fiduciary advice from a Series 65 advisor or suitability advice from a Series 7 advisor, and they're not required to disclose whether they're giving fiduciary advice or suitability advice. So the problem with that is you don't know the advice that you're getting. Is that really in your best interest, and is that really a fiduciary recommendation?
That's right. So, Mark, I think that one of the biggest decisions that people make in retirement is whether or not they will work with a fiduciary. We hope that you work with a fiduciary for obvious reasons that, Mark, you've discussed for the last 7 minutes. Mm-hmm. Anything more before we change topics? Anything more on the fiduciary topic?
Yeah, real quick. A firm that is registered with the Securities Exchange Commission, the SEC, is called a Registered Investment Advisory Firm, an RIA. The SEC holds all of their advisory firms to the fiduciary standard. So by law, an RIA firm has to act as a fiduciary. And then one more plug for the Certified Financial Planner designation. Somebody who has the CFP designation is personally held to the fiduciary standard.
So, Mark, again, if radio listeners are writing a note, there's the 3 checks to see if your banker, broker, your advisor is a fiduciary. Is number 1, they have to be independent, able to work with any of the financial products out there. Number 2, they've got to be Series 65 licensed, not Series 7. And 3, their firm needs to be registered as an RIA, Registered Investment Advisory Firm. If they are not all 3, they are not fiduciaries. And if they're duly licensed, then you can't know if they're talking to you out of their fiduciary side of their mouth or their non-fiduciary side of their mouth. So we hope that you make this very, very important decision in dealing just with a fiduciary. Anything more on that, Mark, before we move on?
Yeah, I would add that as a fiduciary, anybody who's giving you advice is going to be more focused on a comprehensive plan and is going to be more focused on tax efficient strategies, investment growth, keeping your costs low, rather than looking at what specific investment product to sell you or what the specific investment type is. They're going to be a true believer when it comes to tax strategies, comprehensive planning, fee minimization, putting a plan together that accounts for all the moving pieces of a retirement.
So again, if you'd like to sit down with a team at Decker Retirement Planning and talk about your situation, income, where's it going to come from? Paycheck's no longer coming in because you're retired. So where's your income going to come from? Investments, too much risk, not enough risk, the right amount of risk. Everybody's situation is unique. Taxes, big deal in retirement. Healthcare, long-term care, another huge deal in retirement. And of course, legacy planning. How are you going to leave things? 833-707-3030. Brian, Mark, and the team at Decker Retirement. It's all about you. How can they help? If they can. 833-707-3030. When we come back, Mark and Brian are going to talk about the distribution plan, and then they're going to get into the risk bucket. That's ahead in our final segment of today's Safer Retirement Radio with Brian J. Decker and Mark Knauss of Decker Retirement Planning. Stay with us.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Mark Knauss of Decker Retirement Planning. I'm Mark Elliott. Again, you can always learn more on the website, DeckerRetirementPlanning.com. You can always give them a call if you got questions. 833-707-3030, 833-707-3030. Talking a lot of different things as we always do on this program. But Brian and Mark Knauss talking about, two topics left, I think? Now we're into the distribution plan and the risk bucket, right?
That's right. So, Mark, describe for our radio listeners what a distribution plan is and how it works.
Sure. So a distribution plan, as opposed to the 4% rule, is going to map out your income sources, fixed income and portfolio income, all the way through your retirement years to age 100, to the end of a plan, assuming some cost of living adjustments and assuming some inflation and assuming some portfolio performance. So between the portfolio performance, your fixed income strategy or your fixed income sources and taxes, because you have to pay taxes, we want to look at what is your net annual and your net monthly income that you can anticipate receiving every year for the rest of your life, using some very conservative estimates.
So, Mark, I'm going to say what you said differently. We're a math-based firm, so on a spreadsheet, a distribution plan takes a look at your Social Security income, any rental real estate if you have it, takes a look at pension and portfolio income and adds them up under gross income minus taxes. That gives you annual and monthly income with a 3% COLA is what we show you for the rest of your life to age 100. We don't expect you to live to age 100, but we do want to make sure that your money outlives you. So imagine the difference, the sigh of relief when people come in and we put their draft one of their distribution plan in front of them. Mark, they lean forward and they love what they see, right? And describe, Mark, most of the time they're seeing distribution income per month much higher than what they were getting before, correct?
Much higher, because we map it out that way. Our distribution plan, we call it our max income plan. The question that gets asked so often is, how much can I draw from my portfolio every year for the rest of my life without running out of money? And that's what this planning tool is designed to answer. A distribution plan that looks at what your portfolio is, what your fixed income sources are, and what kind of income you can expect to see for the rest of your life. That's how you do distribution planning.
Okay. Now let's talk about the portfolio side. We've got laddered principal guaranteed accounts and the risk bucket. So describe the 4 key reasons why we foundationally have income coming from laddered principal guaranteed accounts.
With laddered principal guaranteed accounts, there's tremendous peace of mind that comes in retirement when you're drawing from accounts that have no downside risk. By principal guaranteed, we mean no downside risk in the stock market when you're drawing from your portfolio. If you're drawing from a portfolio that has a fluctuating account value, you're compromising gains when the market is going up, but more importantly, you're accentuating losses when the market is going down. And it makes it so much harder for the portfolio to recover. So by drawing income from principal guaranteed accounts, there's tremendous peace of mind. The second piece is using a laddered strategy. Say you have your short-term income bucket, your medium-term income bucket, your longer-term income bucket. You're allowing your portfolio to take advantage of compound interest by moving more money to the back end of your plan and seeing higher growth potential in those accounts. The third piece is a risk bucket. The risk bucket is a brokerage account or an investment account that is designed to get S&P-like returns or better for as long as possible. So now you have 10, 15, 20 years of investment growth in a brokerage account. While you're drawing income from principal guaranteed accounts, you have an investment account that is growing, and its job is to replenish the income buckets later on in retirement as they're depleted. And the last piece is you want to make conservative projections on your growth. If you say your growth rates will be 1 to 6% over the course of those buckets, and the reality is that your growth is 5 to 15% or 5 to 20% on those buckets, then all of a sudden your portfolio and your income plan looks better and better and better every year that we're meeting, because we'll plan for this amount of growth. The reality comes in and your growth is much higher than anticipated. So we're talking to clients, telling them that they're ahead of schedule or that their plan looks better than we anticipated. And the sense of relief that comes in those conversations is tremendous.
In human nature, people want to hear those words, you're ahead of schedule. So we do that on purpose. We put the bar low so that every year they have high confidence that their money is going to be at least that for the year. Mark, now with the remaining time in the radio show, you talked early in the show about the flat market cycle that we're in. Do a quick review of that, like in 90 seconds, and then let's dive into how we plan on capitalizing and making money on a flat market cycle that could be so devastating to people in retirement to go 10 or 15 years with no equity returns.
Right. So just looking at the history of the stock market, there's been 4 times in U.S. history where we have seen market valuations, specifically price to earnings ratios, S&P to trailing earnings of the S&P 500 at 30 times trailing earnings. We saw it right before the Great Depression, 1929. We saw it again in 1964. We saw it in 1999. And we saw it recently in 2021, where the S&P traded 32 times trailing earnings. If history repeats itself, which it has 100% of the time, we could see a flat market cycle over the next 10, 15, 20 years where the S&P is flat and choppy for a long period of time when retirees need that growth in their portfolio to account for the rising cost of food and energy and inflation.
Okay, so what is our response then to how to make money in a flat market cycle?
In a flat market cycle, we've gone back and we did our homework, and there's a great book by James O'Shaughnessy. He wrote a book called What Works on Wall Street, and he looked at all the different investment strategies out there. His conclusion was not the top 1, 2, or 3 investment strategies, but the top 15 investment strategies out there are what's called momentum strategies. Another name for it is relative strength or sector rotation. 3 names, all for the same strategy. What you are identifying is what sectors, what indexes, and what stocks are trading up, have positive momentum, and you are rotating into those strategies based on a relative strength score compared to cash. So, for example, if the tech sector has positive relative strength compared to cash, then that's your fastest moving sector, and you want to move into that sector. And if another sector comes along that has more momentum than that, then you transition into that sector. So that's a momentum strategy. And in a flat market cycle, these strategies have significantly outperformed the S&P 500 in both sideways markets and up market environments.
Okay, so let's give some history on these. So, for example, in 2000, 01, and 02, the S&P is down 50%, NASDAQ's down 70%. And during that period, there were many sectors of the market that did well. In 2000, 01, and 02, when people were losing a lot of money, if you invested in real estate through the REITs, gold, silver, energy, pharmaceuticals, biotech, healthcare, all those stocks made double digits each year for 3 years. And then the markets bottomed in March of 03. And what exploded to the upside for 4.5 years were technology, semiconductors, small caps, and emerging markets. They made huge gains. So you rolled into those. And then going into 2008, that was a waterfall decline. So the way momentum works is it has stop losses. So you were stopped into cash with one exception, and that was treasury bonds. Treasury bonds were up 22% in 08. More recently, when in 2022, S&P's down 19, NAS down 33, bonds down 20, commodities across the board were down with one exception. Momentum had you invested in energy. The frackers, the drillers, the natural gas companies, the crude oil companies, and the pipelines made 15 to 20% when most people lost 30% that year. So, Mark, with the remaining time we have, describe how it's a two-sided strategy, an offense and a defense.
Sure. So we use offensive managers that have historically gotten S&P-like returns or better in up market cycles. So what do we mean by an up market cycle? When the S&P 500 is trading above the 200-day moving average, we are said to be in an up market cycle. This is a time period where you want to be offensive in nature. So we subscribe to 5 different databases of money managers, and we have identified momentum strategists that have historically gotten S&P-like returns or better in up market cycles when the S&P is trading above that 200-day moving average. But in down market cycles, where the S&P is trading below the 200-day moving average, we want to use managers that are still using momentum strategies, but have historically made money or at least preserved money in down market cycles. So the defensive managers that we've identified have done exactly that. They have made money or preserved money in down market cycles going all the way back to 2007. These managers have made money every year that the S&P has been down. So having offensive managers in up years, defensive managers in down market cycles, you're able to make money on both sides of a market cycle, and that's the strategy that we use in the risk bucket in our distribution plan.
So if you'd like to learn more about it, you want to sit down with the team at Decker Retirement, you're going, that sounds kind of interesting. I don't really understand it. I'd like to learn more. Give them a call. There's no cost. 833-707-3030 again is the number. 833-707-3030. If you have questions about your investment strategies, where's your income going to come from, taxes, healthcare, legacy planning, Social Security, and Medicare decisions, it's all a part of the safer retirement process. 833-707-3030 is the number. Give them a call. Might be the most important phone call you make. 833-707-3030. Brian, Mark, appreciate the time. You guys enjoy the rest of the weekend. We'll be back with more Safer Retirement Radio next week. Same bad channel. Have a great weekend.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.